So we have the end of round two, and an interesting round it was. I'm sure you've all looked at the results, anxious as I am, and I do get anxious. It's actually kind of exciting. I know every now and then I forget on a Monday morning to process it, but just as often I get up and I'm still at home, actually, probably still in my bathrobe, and I'm going, I wonder how that round turned out, and I'll actually process the round from right there and take a look, and I think maybe more so than other classes, I get kind of excited about it because it's going to be different every time, and it is different every time, and that's what makes it fun for me, I think, as an instructor, and I hope you guys are to the point now where you're kind of enjoying at least the competition, if not the assignments that I make every week, although I think I'm starting to see some improvement there, a little bit more thought going into it. I think, I don't know, early on I get the impression sometimes that, and I may be completely wrong about this, but I get the impression that you wonder if you can kind of blow it off and write some stuff down without really investigating, and I think as that goes on you realize that no. Well, I think two things happen. One, you just learn more stuff because you're playing the game on a weekly basis and you're kind of starting to understand it a little bit better. But two, hopefully you're realizing that, you know, my expectations are a little bit high on that. You know, in this course we're not doing a ton of stuff, you know, other than the game and then doing these assignments. You are going to have a CompXM test that you'll have to do here that I'll be getting out shortly, by the way. I've ordered those. We'll get them out probably by end of this week or next week to you guys, and I'll talk more about that when I send them out, so you guys get it and can get that completed before the end of the semester. So let's go take a look. Let's see what happened. Let's go look at the assignment from last week first. And let me get it to the Round 1C right there. And the assignment was, why did Digby have such a low contribution margin? Now I want you to, I've oversimplified my answer, so you know, but at this point I hope you've come to realize that contribution margin is really just a function of two things. One is price and the other is variable cost. Okay, so if it's not one, it's the other, and when I say I've oversimplified my answer, it's because you know, certainly we could break some things down a little bit further, and my expectations, especially going forward, is that you might break them down a little bit further, and we'll talk about that maybe in the assignment for this coming week. But you know, it had a low contribution margin. I even wrote in general, two things affect contribution margin. One's pricing, the other's variable cost. It's really difficult to, in this game, radically increase your cost, your variable costs. Okay, each round that goes by, I think both your labor and material costs go down. Now, and the reason I hesitate, and I said I oversimplified this, is because relative to other teams, your costs could go up. That's the bad term, but relative to other teams, your costs could seem high because you didn't do some things, right? Because you didn't invest in automation or HR, TQM, and other teams did, okay? Or your MTBFs are higher, and so your material costs, and certainly you'll drive your costs up a little bit if you're always on the front edge. And that should be a part of your strategy, actually, if you're competing in the high ends and performance size and high, okay? But start with the premise always that there's two things, right? Okay, and so if I look at Digby and I look, you know, they're, you know, it's variable costs weren't really out of line. You know, if you go down each particular line item or each particular segment, I'll take a peek here. you know, we look at each segment and its costs here, you know, if I'm comparing it to some of these other teams, you know, a lot of ways it's lower actually, okay, on the variable cost. And so that leads me to one conclusion, really, is that it's probably got to be pricing, and I can easily check that out, right? You know, 24.50 on the traditional versus 27, 28, 29.50, 18 on the low versus 2019, okay? And so there's a pretty quick pattern that's been established there that it's definitely, you know, the pricing that was at least the main thing, so, right? And so our conclusion is that Digby's prices were quite low, okay? You know, always start with the simple, you know, the two things that make up contribution margin, and then go from there. And I think as you're playing the game, if you really concentrate on those things too, it can really make a big difference. And especially as we get down, you know, when your sales get up around 200-300 million, which they will towards the end of the game, you know, having a % or two difference there can be huge. This can be huge. So Chester spent a lot of money on plant improvements, or where or upon what did it spend its money? Okay. Again, if you're doing plant improvements, there's really just a couple things that you can do if you're spending money. You know, if we look at Ferris, for example, they obviously sold capacity, okay, because theirs was positive, and so they had a positive cash flow because they sold capacity. But if you're spending money, so if you got a negative cash flow and you're spending money, really all you can do is buy capacity or buy automation. So again, keep it kind of simple. Okay, so and I think I asked it about Chester. So what did Chester buy? Well, you know, these capacity levels are what you started with. And I could go back and look, but I know they are, and you can see most teams still have that. So it didn't buy capacity, but are these changed? Yeah, it looks like they bumped each one of these up one notch, and that's your automation. And so it spent its money on automation. Okay, I should be, if I'm not Chester and I'm analyzing Chester, which I should be starting to look at that and say, I wonder if that gives me any hints about what Chester might be doing for a strategy. Can I come to a conclusion? No, because you know, other teams, we know, for example, what Ferris's strategy is going to be, right? And yet I think it spent some money, yeah, it spent some on automation, okay, even though it had a net positive cash because it sold some capacity. It did spend some money on automation, and yet they're a high-end, right, differentiator. And so, yeah, it doesn't mean that you're necessarily one or the other because you're spending money. They're not mutually exclusive, but we should start thinking about that. Okay. 3, approximately how much higher would Andrew's earnings per share be if it had not sold any shares? Show your work. So it made this much in profit, $1,233,497, which we could go look at on here, right? 1,233,000. The full number's up here, though, isn't it? Yeah, 1,233,497, and it had sold. I'm sorry, I just divided by the original shares outstanding, 2 million, right? Because it sold an additional 100 and some thousand shares or something. So had it not sold any shares, it would have had the original 2 million shares, okay? And so it would have made about 62 cents, and it did make 57 cents, so it would have been about 5 cents higher, okay? And likewise, it could have bought back stock, and it could have bought. How much did it sell? Let's go see how many shares did Andrew sell. It sold 142,000 shares. So let's say it could have bought back instead of selling. It could have bought back 100 and some thousand shares. I think it would allow it to do that. It could have bumped its earnings per share up another 5 cents. So it could have got up from 57 up to 67 cents by kind of reversing that transaction. And 4, approximately how much higher would Andrew's ROE be had it not sold any shares? Show your work. And again, same amount, right? Its profit was this. Its equity, okay, total equity was $54,096,000. I get that from the balance sheet. Total equity, $54,096,000. And these are rounded, so I just went ahead and rounded. And what it generated from the sale of its stock was $5 million. Okay, so I subtracted that because had it not sold the stock, it would have $5 million less in equity. The stock sale goes right to equity. It goes to assets, which is part of equity. Well, total assets equals total liability minus, or I'm sorry, total assets equals total liabilities plus owner's equity. So if you add an asset, you either have to add a liability or owner's equity, and if you're adding cash, then basically that goes to assets and to equity. So its ROE would have gone up to about 2.5%, or about 0.2% higher. Okay, again, seemingly not a lot, but keep in mind that's going to be round after round. Okay, and it over time could be pretty significant. Over time, it could be pretty significant. Five wasn't a good question. Okay, so I'll probably not really consider it when I, and the reason it wasn't is because I couldn't make my numbers coincide with what the report had. But what was the actual cost of your team's emergency loan? I said show your work. Each team's going to differ, of course, but I took Chester as an example, and really, here's what I'll do. I'll log in as if I am Chester, just to let you guys see where you could go and find that. Okay, under reports, industry reports, annual reports, and I want to view it for round 1. Okay, and their emergency loan, I think it shows it up here someplace, doesn't it? Under the current debt, because that was the only current debt they had, $22.082 million, and it shows it's under the income statement, though, short-term interest, which would be all on the emergency loan, was $3.5 million. Well, 7.5% is a fee that's charged by Uncle Al, okay, which is about $1.6 million. And if I did the balance of it, the interest rate would have had to have been 8.3%, and yet their short-term interest rate, according to the guide, should have been, I got to go back all the way back to the Courier, so give me a second or two to do that, but its short-term interest should have been, is it 1.5% below the rate at which it issued long-term debt? I believe that's correct, and since Chester did some long-term debt, right, 8.2 million at 12.5, I think it's 1.4%, because I think what I had was 11.1% is what it should have been. When I do that math, it didn't work out quite right. And so the real answer for Chester, the way it came across, or the way it worked out, was that it should be that 3.505 million right from the income statement. There is the amount that they actually pay. So it doesn't really take any calculating. So I'll probably give bonus points if we get some folks that got that right, and I won't take away if you didn't, because kind of an awkward thing. Like I said, I couldn't get the math to work out. Maybe one of you guys can put that together for me. I don't know. Okay, so that was it for that. Let's take a look then at round 2 and what we found interesting about round 2. Well, the first thing that jumps out at you about round 2 is that each and every single, you can see that from the top line, student-run team lost money. I don't know if that's a first, for a second round. I think I've seen that in first rounds, and I've certainly probably seen it in practice rounds, but for the first time, maybe. Now, do not take that as a criticism, and the reason I say that is because and that's why I find this interesting. As I went through what's going on, I see teams starting to really, I think, take my advice and maybe make some moves, relatively bold moves toward fulfilling their strategy or pursuing their strategy, and sometimes that takes on a little risk, or forces you to take on a little bit of risk. And so no doubt that is probably what happened for at least some of the teams. Okay, some of the teams might have been just poor choices and whatnot, but for some of the teams at least, it's because of the bold moves that they're making. And if I were one of the other teams, I'd be really concerned about that. Okay, we see sales. Interesting that a couple of the student teams had sales better than Team Ferris. And if you remember, I think in the practice rounds, Team Ferris is running away with sales at this point. So I see we're being more competitive on the sales end, and that's a real positive. EBIT, earnings before interest and taxes, those are all positive. Baldwin would be the exception there, but EBIT then pretty good. So we know then that it's interest, right? Because if your interest took you negative and taxes, you wouldn't pay taxes if you had a negative. So our profits were negative, so we know that there's some interest involved in that. Cumulative profit I don't worry about. Of course, I look at the SG&A to sales, and look at, holy cow, Baldwin, a huge 15.7%. And its sales were relatively low, so I don't think it spent as much as, I know it didn't, I can tell by looking at the numbers, didn't spend nearly as much as Chester, and yet it had low sales. Okay, and likewise, Erie spent less overall, I think, than Baldwin. Do the math there. No, it spent a little bit more, but it was still far more efficient and effective at doing that. Okay, and so you got to ask yourself a question: why? Why could Erie spend only 7.1%? So, take that times that, and you get about 10 million, whereas Baldwin spent over 16 million, 15.5 million. Okay, and we'll see that when we look at the income statement. Why was Chester so much more effective then at generating sales? You ask that question and then go find the answer. That's not one of the questions for the assignment, but if I was Baldwin, I would sure want to know the answer to that, and then I'd want to try to do things to emulate or actually beat Chester. Okay, contribution margins then, look at that, low, only a 15% contribution margin. Wow. Okay, maybe that's one of the reasons it was able to generate some sales, because pricing could be, okay, but only Ferris had a high contribution margin. Everybody else was extremely low, so interesting to see why. Okay, and then different competitions they always take on their own persona, and it's always interesting to see that. So okay, so stock market summary. Looks like it might have had a couple more teams sell a little more stock, not a bunch. Digby had a decent stock price, the only team kind of hanging on a little bit other than Ferris. Otherwise, everybody really went down. Okay, earnings per share, of course, all negative if the profits were negative. So calculating the effect of the sale of stock on earnings per share, actually this one's to an advantage. If you're losing money, having more shares outstanding would be better, because you'd lose less money per share in that case. But let's hope that we don't have a competition that ends up being just who loses the least money through the next 7 or 6 rounds. So we look at again the cash flow, and I love to come here. I don't generally spend a lot of time up on top. Okay, I'll take a look, and you can see that changes in inventory had a huge impact for Andrews, huge impact for Andrews. So they had a really big increase in inventory. Baldwin somewhat. Other teams, Digby did too. Erie, Chester, Ferris kind of got rid of some inventory. Still some big spending here. Okay, plant improvements. Digby, on the other hand, didn't do much. Maybe that's why. Maybe one of the reasons why Digby didn't lose as much money. It's possible, because remember, interest was an issue, and interest is the only thing. The spending money on plant improvements, again, I want to emphasize, the effect of that on your current income statement would be pretty minimal, because you're just exchanging one asset for another, right? It's a huge cash negative, right? But you don't get to write off, or that is not, a part of your expense, the $32 million. It increases your depreciation, certainly, and it increases your probably your interest, assuming you have to borrow money to make that happen. Okay, and so it's not, to spend a lot of money on plant improvements, again, is not necessarily a short-term negative. You got to offset that too with the fact that if you're spending money either on capacity or automation, you're probably saving money then on employee costs. One or the other, it's probably saving some money on labor costs. Okay. Onward we go. Any other things? Yeah, we did see a couple teams, more teams issue some debt, some long-term debt, and retirement of current debt. Of course, that was just last year's, and we saw, I thought, yeah, some teams, Baldwin and Erie sold a little bit more stock. Looking at the total assets, we see Erie's become a big team already, in terms of total assets, huge teams. But remember, they spent, I think, quite a bit last round in plant improvements and quite a bit this round in plant improvements. And so that could be, nevertheless, they don't have that much more equity, so obviously they got a lot of long-term debt. And we should have looked at that when we were up here, but we see Erie, yeah, has borrowed a lot of money, a lot of long-term money. And probably some short-term debt too. Not too bad, not a ton of short-term debt. Okay, certainly not as much as Baldwin and Andrews. Of course, theirs was big emergency loans. Sales variable costs, do we see depreciation? Yeah, Erie, we would expect them to have bigger depreciation. Erie had a lot of SG&A, but remember their SG&A expense was, yeah, fairly high. It was fairly high. Okay, $20 million they spent to generate some sales, but they might be working on trying to, yeah, we'll take a look. I think we'll see in a little bit. How come they had quite a bit of SG&A? Oops, down here, other fees, write-offs, not much there to look at. EBIT, interest, yeah, huge amounts of interest, Andrews and Baldwin, but that's because of emergency loans. Erie, a lot of interest because of some of the plant improvements and whatnot that they've been making. So still tons and tons of capacity, right? We've through all the practice rounds now and through the first two rounds here, just excess capacity and no seeming desire to really change that, which, okay. I'm going to skim through this a little bit. I will point out inventory, okay, and one of your questions is going to be regarding inventory because I want you to do a little bit of math in regards to that, and it's simple math, it's just addition. But we can take a look here. Remember we said that they spent a lot on SG&A, or he did 2 new products. Team Ferris only introduced 1, and they were pretty aggressive about that. So we see Team Erie introducing 2 new products, and when you introduce some products, you probably spend some money on marketing, and so they probably did that in R&D too, and they also had to buy more capacity, and so there's your plant improvements. Okay, I'd also point out they spent a ton of money there, obviously increasing their automation in the low end. And this is automation for next round, so they spent the money for automation, but it'll be next round that it has an impact, and be interesting to see, you guys should pay attention to that, what impact it has on their labor costs for next round. Chester dominating the traditional segment. I wonder why that is. Well, if we look, and the smaller one here's not as good, but look at that. Chester has 1, 2, 3, 4 products basically in the segment. Okay, so none of them, well, cake's pretty high up there, but then Cure, Coat, and Sid are just each getting their slice, right? One of the reasons Chester had a low contribution margin, probably, okay, because they've had these products. I talked about this in the practice rounds, but moving these products in there, it's not a bad strategy at all, and eventually the costs will come down. There's some things that they could do certainly to lower the cost that would not probably have a terrible impact on sales. Okay, but you have to lower the price, and then to a certain extent it takes a while for the cost, like your material costs. Again, there's some things that you could do there, and it takes you a while to readjust your labor costs to get them kind of in line. But eventually, having all those products in there could be a good advantage. So, Low end's kind of dispersed. We see pretty good competition there. Chester's still kind of dominating, followed by Erie though. Okay, so we got a couple of them there. A little bit of a cluster. I find it odd that this one's already kind of exiting, you know, and so what that means is that somebody purposely moved it backwards. Now, moving a product backwards is kind of odd. Okay, you know, I don't know if that's looking for the ideal spot, maybe, because maybe it is back here a ways. That's possible. But that's pretty low on the customer buying criteria when price and age are going to be more important. And when you move them, you kind of, I think you change the age. It might actually make it look a little bit younger. I'm not sure, but probably not. You know, this you see that Ferris, I'm sure they haven't moved their product. They've just kind of let it sit there. They sold out. Did they have? Yeah, actually they had more potential, so they could have sold even more, right? and haven't had to spend any money. The rest of you guys, you know, you've moved your product around obviously, and you've spent money on R&D to do that, and so that's kind of interesting. High end, ooh, look at that. Remember in the practice rounds, Ferris dominated, but Erie, and we know that they introduced some new products, maybe one in this segment, looks like it. Interesting that they'd put it right on top of the other one instead of maybe trying to get a little different area there, but still kind of dominant, you know. Good sales going on there. Two products, Echo and Ego. All right, so 31% of the market. Sold a little bit of some of these other products that just happened to be out here. Must have been on the outskirts. And then in the performance segment too, Erie kind of dominant. So maybe one team has decided to compete at size too. Ferris still dominant in size. That's the one segment that Erie didn't introduce a new product in, of the high-end ones, whereas we see Ferris and Erie just have one product each in there. And interesting, yeah. We didn't see a ton of disconnect, you know, small ones, disconnect between potential and actual, you know, just kind of small ones. A little bit here in the low end, but again, not as big as some of the disconnects that we saw earlier and in the practice rounds, and we'll see how it fares out. Looking at this again, should be able to kind of look at this and start to get an idea of where things lie. Remember I talked about, well, it might be one of the questions I get asked. Did I ask why Baldwin didn't sell very well? Yeah. Yep, so I'm not going to answer that question because number 4 I asked is why wasn't Baldwin very efficient with its SG&A spending? You know, part of the reason might be on this view here if you look at that. So I like looking at this and it gives me a pretty good idea where teams are at, even though we're seeing a little bit more competition for Ferris up here in the high ends. You know where they're positioning themselves, you know, and this is at the end of the year. So at the start of the year, you know, or I'm sorry, when they have their revision, okay, which is probably towards the end of the year because they're probably getting their revision date out into December. But they're pushing the limits out here, you know, and even if you got a little bit outside that line, probably wouldn't hurt you, okay? And so just to give you an idea what Team Ferris is doing, and you got to be cautious about that because you don't want to go out, you don't want to be revising it too far into the future. Looks like Baldwin actually did that here, so they're going to be making some radical moves, but they got out in the future, so now they're not going to be able to make any changes. Hint, or not a hint, but it'd save you from sending me an email, Baldwin. Your revision dates went out, and if you get out too far, if you revise it too far, and the guide kind of explains that, you won't be able to make any revisions to those. Okay. It's also going to have a pretty adverse effect on your sales probably for those products because they're going to appear old until they actually revise. So Team Erie, again, only team really spending enough, or did spend enough money to actually get some productivity gains. Not a bunch, but 2%. 2% on, what were there, probably 50 million, so they probably saved $1 million. Okay. there we go. That's a pretty good roundup of what happened pretty good roundup of what happened that round. That's almost like a pun or something. Let's go through the assignment. Why did all the student teams have very low contribution margins? So again, look at it in a general sense, but please maybe elaborate a little bit more. I think I said, going over that chapter or the round one assignment, there's very simple reasons why that happens, but you might want to take a look at it and be a little bit more specific for each team. I think you might find some other specific reasons. So why didn't Andrew's traditional product, Able, sell very well? And the same question for Erie's traditional product, Eat. So kind of specifically taking a look at those those products and tell me why they didn't sell. And when you go through that, just think of all the things that makes a product sell. Okay, yeah, think of the things that make a product sell. It is the customer buying criteria. It has that, but there's a couple other things too, including inventory on hand for all teams. What is the total potential number of units that could be available for sale next round? Assume that all teams produced at full capacity. So you have to add up all the inventory that's in the traditional. Ooh, and I only wanted this in the traditional segment, so let's change that. Including inventory on hand for all teams, what is the total number of units in the traditional? Glad I caught that segment. That could be available for sale next round. Assume that all teams produce, gosh, bad grammar, produce at full capacity. Okay. So again, just in the traditional segment, I want you to take a look at that, and then I picked that segment because there's a ton of inventory right in the traditional segment. And so this is a math thing that I think you'll find that doing this later, especially in the game, might yield some good tactical choices that you could make. Okay, and this one's kind of the opposite because we're looking at having far too much inventory. As the game goes on, you might be looking at it the opposite way, as to maybe not having enough inventory and/or production. Okay, and that might create some tactical opportunities. So, then, why wasn't Baldwin very efficient with his SG&A spending? We know that it spent quite a bit without generating real good sales, so be more specific with your answer. So, yeah, I don't want you to just say, hey, well, they spent a lot of money and they didn't get much sales. Okay, I want you to be specific as to why didn't they get the sales? If they spent so much money on marketing, why didn't they get the sales? Okay, better save that. And we're to the winner, or I think what we could say in this round, we'll call it the unloser, right? Because we didn't have a winner really, because nobody made a profit even, and so we're going to have an unloser, I guess, for this particular round. So here we go. If we take a look, round 2C, okay, make sure I'm in the right spot here. Come down and we got earnings per share, Digby as the student teams, and ROE, Digby. Contribution margin, Digby as well, and stock price. So again, it's not that theirs was great, it's just that it was less worse. Profits. Yeah, Chester had the best cash flow. And strategy, so big, but boy, we know that there's probably some deductions. Well, emergency loan, 3 of the teams had emergency loans. Every team is negative in leverage. Again, I don't necessarily deem that bad, especially early in the game, although I do deem it risky. And working capital, so Digby only had 1 deduction, whereas a lot of teams, every other team had at least 2. So not only did it get the high score there, but it had fewer deductions, and so ended up with an 85. But Digby also didn't reach out. They didn't spend a lot on plant improvements going into the future. So kind of excited to see how some of those investments pay off as we move forward, because like I said, I do see some things happening that could be interesting, more in line maybe with my exhortations that I've had early on. So with that, I'm going to sign off and wish everybody a good week, and I'll talk to you next week. Good luck in round 3. Hopefully we'll have a winner instead of an unloser.